Hello and a warm welcome. You've joined us here on ET Now and all about your company. I'm Asheshad for you, and on the show today we are going to put the spotlight on Coal India, a stock which has outperformed the Nifty over the last few days, and there are several factors that are aiding the move. We'll discuss all of that in just a bit, but first up, let's talk about the most interesting things that are transpiring in this space. Remember, summer is expected to be hotter this time around, and that is likely to aid power demand for Coal India, and that is one of the factors which continues to remain at play. That, remember, is the only stock from the Nifty 50 pack where analysts have negative return expectations over the next 1 year. Analysts, in fact, have gone ahead and cut their target price on Coal India in 2025. Management, meanwhile, has given very strong commentary when it comes to production and outlook, not only for this year but for the next 5 years. So that is another metric to watch out for. The stock gave 80% return in calendar year 2023 and no return thereafter from December 2023 to 2025, but it is up 25% over the last 4 months. So what is leading to that, and what's the outlook going forward? Those are some of the big questions. Now remember, we have expectations of strong summer, as I just pointed out. Perhaps the stock could outperform going forward, and as I mentioned, the management has given very strong guidance for calendar year 2026 and even for the next 4 to 5 years period. Let's also talk about diversification, which continues to remain at play. Many of its subsidiaries are on course to get listed on the bourses, so perhaps we could see some bit of value unlocking that could play out for this counter, and e-auction premiums are expected to surge on account of surge in coal prices in the global market, and the company generates about 10% of its revenue from e-auction sales. So that is also another metric that you need to watch out for. Let's talk about the company then. It was incorporated in 1975. It is currently a Maharatna company. It is the single largest coal producer in the world. It operates in 85 mining areas and it manages 310 working mines across the country. 80% of domestic production comes from Coal India. 75% of coal-based generation is sourced from Coal India's mines. It contributes to 55% of total power generation, and 40% of primary commercial energy requirements are met through Coal India's offtake. So that's how important Coal India is as a company, not only for its shareholders but for the country at large. Let's talk about a couple of other financial metrics which continue to remain at play. And the first, of course, has to be the revenue front, where in FY22, a company generated revenue of 1.1 lakh crore rupees. The company has given a CAGR of 14% in terms of revenue over the last 3 years. In FY25, its revenue stood at 1.43 lakh crore rupees. We'll also talk about the 9-month period in just a bit. As far as EBITDA is concerned, CAGR over the last 3 years stood at 38%. 47,000 crore of EBITDA is what the company reported for FY25. Let's talk about margins, and they have been volatile over the last few years. One, of course, is on account of change in valuation metric and accounting metric that the company did in FY23, and that is the reason margin shot up from 22.5% in FY22 to 32% in FY23, and then they've largely remained stable in that range. For 9-month FY26, margins stood at about 28.3%. Let's also talk about the 9-month period and how those metrics stand out. As far as profitability is concerned, the company has reported a CAGR in net profitability at about 43% over the last 3-year period. So that's the profit metric for you on your screens. But let's also talk about the 9-month period, and as I was pointing out, revenue for the 9-month FY26 stand at 1 lakh crore rupees, which is a decline of 3% on a year-on-year basis. Margins, meanwhile, have also contracted from about 32 basis points, 32% that the company reported over the last 2 to 3 year period. They have deteriorated to 28.3%, which is a decline of about 5.5 basis points YOY, and profitability too has declined by about 22%. We'll try to analyze why this has happened with the analyst who is just joining us on the show in a bit. As far as coal offtake is concerned, last year it stood at 763 million tons. This, of course, was for the full year FY25. This year, for 9 months FY26, company has reported coal offtake of 546 million tons, which means largely for the full year, company will be at par with what it had reported in FY25. We are not expecting any bumper offtake growth for full fiscal this year. So that's as far as the coal offtake is concerned. Production, meanwhile, has also been in line with what offtake has been over the last few years. 774 million tons is what it reported in FY25. This year so far 529, and it is expected to be at par with what the company reported in FY25. Let's move on to balance sheet and some other metrics which continue to remain at play for the company. E-auction trend, and this is very important. And as I just mentioned, coal prices in the international market are rising, because of which demand from domestic players is expected to be on the higher side, and that will aid e-auction premiums for the company going forward. The company generated significant amount of sales from its e-auction premium. Over the last few years, e-auction premium stood at just 14% in FY21. It shot up to about 228% in FY23, and now in FY25 it stood at about 68%. But this is expected to rise, especially in light of surging coal prices and also on account of higher demand in the upcoming summer season. Shifting focus to the balance sheet metric then, equity in the first half of FY26, at the end of first half FY26 stood at about 6,160 crore. Total book value stands over 1 lakh crore rupees, and the borrowing is just at about 13,500 crore. So clearly, borrowing is not a concern for Coal India because it is much lower as compared to its book value. Cash flow to EBITDA at about 62% is also solid. Net cash flows for FY25 stood at about 5,800 crore rupees, with EBITDA of about 47,000 crores that the company reported in FY25. Let's also talk about valuation and a couple of other metrics which continue to remain at play. But before that, return ratios. It stood at about 48% for FY25, which declined from 78% that the company reported in FY23, followed by 64% in FY24. So that's as far as the return ratio is concerned for Coal India. Shifting focus to the shareholding pattern then, and promoter shareholding by the government has largely remained same at that 63% mark. Government has not sold any stake, at least in the last few quarters. FII shareholding at 8%, DII at 22%, and public shareholding at 6%. So clearly the free float in the market for Coal India is limited on account of higher shareholding by the government. Now, on the valuation front, the stock trades at 8.5 times 1 year forward price to earning versus 7 times, which is the 5-year average. And the 5-year average price to earnings range is 5.2 to 10.6 times, which means the current valuation is at the higher end of the 5-year valuation range that the metric is suggesting. So that's as far as the valuation is concerned. And we'll discuss this too with the analyst who is just joining us in a bit. As far as dividend yield is concerned, remember, Coal India has been a dividend-paying stock. In fact, dividend attractiveness is what makes Coal India very investor-friendly, especially at a time like this when global turmoil and equity markets are under immense pressure. It gave returns of about 3%, dividend yield of about 3% in FY29, and it rose to about 5.5 to 6% in FY24 and 25. And it is, in the current year, it is standing at about 5.3%. So dividend yield is another metric that you need to watch out for. But we also spoke to the management yesterday, and the management sounds very bullish on the outlook, on the production guidance, not only for this year, but for a couple of years going forward as well. Let's go across first and listen in to what the management has to say. So word coming in from the management of Coal India, as I mentioned, they're very bullish on the outlook going forward. They're targeting 800 million tons of production in FY26 and about 1,000 million tons by FY30. They've also spoken about capex, getting into renewable, and to discuss what kind of impact could this have on the stock price going forward, we are now joined by Mr. Parthiv Jonsa, Vice President at Anand Rathi Institutional Equities. Mr. Jonsa, afternoon. Thank you so much for taking your time out and joining us here on ET Now. And first, let's talk about the big trigger that is working out in favor of the stock, and that is expectations of delayed monsoon and temperatures which are expected to rise above normal this summer season. What kind of impact do you expect this to have on companies' volume offtake and earnings in the near term, in the next, say, this quarter and the next quarter?
Hi, good afternoon. Thanks for having me on this show. As you rightly pointed out that, the summers are expected to extend beyond a certain, and also we have heat waves right now, right? So usually what happens when you have heat waves, when you have extended summers, the peak power requirement goes up. India requires more power during summers, unlike Western world where you require higher power during winters for heating. We require more power for cooling, basically, as a country, right? So if you see the share of coal-based thermal power plants actually increases during summer season before it goes down when hydro picks up during rainy season. Ideally, the share of thermal power plant as a whole is about 75% in the total power generation, which usually comes out to 60%, then again picks up during the end of the year. So considering delay in monsoons, extended summer, I think the peak power requirement will actually go up in the month of April and May, which will actually keep the demand for thermal power plants higher, and eventually which will drive the demand even for Coal India. Now, as far as the volumes are concerned, what we are building in the entire year volume at about 747 million tons of the entire offtake volumes, and thereafter going to 800 million ton and about 847 million ton in FY28. So this is how our roadmap is basically built over next 3 years. This includes your FSA, this includes your wash coal and the e-auction, all the three parts.
Right. And Mr. Jonsa, what are your views on value unlocking that is being done by the management with respect to listing of its subsidiaries? In fact, the management yesterday was telling us that the street is not penciling in or giving any kind of valuation to its consulting business, which is now on course to get listed on the bourses. Is that true? And what does your SOTP valuation for Coal India actually include? Does it include the consulting business?
I'll be very honest, we value Coal India on a whole because what has happened, one of the subsidiaries which got listed recently, it's about 10% of the business, what they basically, gave out to the people, right? So 90% still they hold it at the end of the day. The similar kind of a thing is expected even for the subsidiaries which is about to get listed in this month, and thereafter they have got in principle approval for MCL and also for SECL, which they plan to list it by the end of the current calendar year. Now, the research division or the company which is expected to be, listed in near term, that is very small as an overall scheme of things, right? If you see the 9 monthly data, it's almost about 2% of the bottom line for the entire company at the end of the day. The major, uptick is basically when the companies or subsidiaries like MCL and SECL will list, because at the end of the day, they are much superior in terms of your entire techno-economic parameter, whether it be OBR, whether it be volumes, whether it be as an overall scheme of things for Coal India at the end of the day. So that is more or a major value unlocking which will happen. But as far as
Right.
the SOTP valuation or valuation of the company is concerned, we give a straight valuation to the entire business as a whole on a consolidated basis.
And how do you value the stock currently? Consensus estimates suggest that the stock is trading at 8.5 times 1 year forward price to earning. What will your estimate be when it comes to valuations?
We have already moved our valuation to 28, which is basically penciling in about 847 million ton of your entire volumes with close to about 100 million ton of e-auction volumes at the end of the day, right? As far as because at the end of the day, your margins basically move not on the FSA basis, but due to e-auction. Now, e-auction has actually gone up in recent weeks or last, especially after the entire global disruption, wherein we expect that at least this current March will be much better than what has happened. A couple of news articles also state that the management expects the e-auction prices to be over 2,500 for the March and thereafter also remain consistent for first quarter. So if you just extrapolate that and everything, it's much lower than the 6x EV EBITDA for on a 28 basis. So there is certainly some room for price improvement, even stock price improvement even from here.
And Mr. Jonsa, what is your target price? I'll tell you why I'm asking you this question. Same time last year when we were looking at what analysts are baking in when it comes to Coal India stock price, analysts were very bullish on this counter. But currently, none of the analysts are bullish even after the run-up that we have seen in the stock. So what is your estimate and assessment when it comes to the stock price and the rating from the current level?
We have a buy on the stock. I'll be very honest. The last release price what we had was about 480. So we still have some room left. We'll definitely revise that the target price and the estimates considering the overall scheme of things. Because what happened is when the results were out the Q3 results were out, the entire global scenario was very different than what it is right now, right? At that time, we already had a target price of about 480. There is definitely some room for improvement even from considering the current CMP, right? So my last price was 480 with a buy call on it.
Okay, and what will your view be on emerging sources of energy? Do you think that is a threat to Coal India's demand? I understand it is not likely to be a threat, at least in the near term. But going forward, over a 8 to 10 year period, is that a concern for Coal India's offtake going forward?
So let us basically break this into three aspects because it's either thermal power plant, you have nuclear, or you have renewables at the end of the day, right? As I told you, renewables usually pick up, and especially from hydro, they usually pick up as a generation during rainy season. So ex hydro, your renewable generation would be about 17%, 18%. During rainy season, it would go to 30% with a share of 60% from thermal power plant, right? Now, as far as your installed capacity is concerned, today we are almost about, say, 50-50 when you consider renewable and others as a basket. Renewables is growing much faster, right? There is a plan to add close to about 200 plus gigawatt in next 3 to 5 years, kind of a time frame. Whereas your thermal is going to be added by about 60 to 80 gigawatts in next 5 years, right? What it means for companies like Coal India is like that 80 or 70 gigawatts is basically supercritical power plant that basically translates to additional 400 million ton of a thermal coal requirement. Now, as far as the overall scheme of things is concerned, we need to understand the geography of India. Most of the sunny days or in the western belt of the India, a lot of industries on the eastern belt of India, there is a huge problem of transmission at the end of the day. That is why the PLF of renewables is much lower than the PLF of thermal power plant. I don't think so. This is a very immediate threat to companies like Coal India or even for thermal power. It's going to remain mounted over the next couple of years. Now, when you come to nuclear, nuclear is a very heavy capex kind of a, you need very heavy capex to basically put up a nuclear power plant. Though it will keep on going up, but I don't think so. The curve would be very sharp. So there is definitely no immediate threat to thermal power or Coal India.
Okay, also wanted your thoughts on the production outlook that the company has shared for the next few years. Now in FY26, the company says that they are eyeing production of 800 million tons with a target of 1000 million tons by FY30. Do you think this is achievable? This is conservative? What are your thoughts on the management guidance on production going forward?
See, at the end of the day, we need to understand 800 million ton production target for FY26. What the management has said maybe yesterday on this channel. That is a very tall ask because 800 is practically about 130-40 million ton for the last month because 11-month numbers are already out. So I think a realistic number is about 750 odd million ton. Considering the uptick in the e-auction which we are seeing in the overall market in the last couple of weeks, right? So I think 747, 750 is a very ideal target as far as a production number is concerned for FY26. Next year, definitely can it grow to 800, 810? If the current market persists, then definitely yes, there is a good chances that it can hit or even surpass 800 million ton. And thereafter, can we reach a billion ton by FY30? As I pointed out, you have multiple new thermal power plants coming in. These are super critical. You definitely require 400 million ton of an additional coal requirement at the end of the day. So achieving that 1 billion over next 5 years, not at all a tall ask. So your long term, I think even we are building in with the same understanding in our mind that it'll hit 950 to 1 billion ton of coal production in next 5 years, basically.
Right, so that's as far as the production target of the company is concerned. But Mr. Johnson, I also wanted your thoughts on company's diversification and capex strategy. The management was telling us that they have 80,000 crores of diversification capex that is lined up for the next few years. And other than that, the company is also looking to generate about 25 to 30% of their revenue from renewable sources. What are your thoughts on company's diversification strategy at a time like this?
It's actually good because they are basically trying to test their waters into multiple different things. As far as the capex is concerned, what we are building in is a capex of 17 to 20,000 kind of a number for next 2 to 3 years, which will keep your FCFF in a positive range at the end of the day. Now, whether they want to move to a thermal plant, which is basically a natural progression for them, or they want to move to renewables, basically as a part of your entire scheme of things, renewables, I do not think it will be 20-30% of the overall top line for them. But yes, can it be a substantial? Over next 10 years, maybe yes, but definitely not over next 3 to 4 years. Because eventually they will take about 3 to 4 years to kickstart all these projects at the end of the day. So any uptick in the revenue in the bottom line will be seen only after 2030.
Right. Also wanted your thoughts on value unlocking. I understand you did tell us that you don't value each of its subsidiaries separately, but do you think value unlocking as a strategy for its subsidiaries will significantly add value for shareholders as well?
For shareholders, yes, because what we have seen in BCCL, it gave a decent, return at the end of the day. As I told you, the two in principle approval what they have received, which is MCL and SCCL, they are much larger. They are the volume game. See, at the end of the day, we need to understand Coal India is a volume-driven company more than anything, right? For us, volume is more important in Coal India, followed by e-auction. Then again, that also related to volume and the premium, right? So I think MCL and SCCL are a volume game. If you see also the offering under e-auction in companies like MCL is much higher than all the other subsidiaries. So once it gets listed separately on the exchange, it definitely gives you a much better value unlocking, and that is what also we are rooting for.
Oh, okay, so listing of its subsidiaries is likely to add value for its shareholders, and perhaps the outlook on the company, especially given higher temperatures this year, looks very promising. Mr. Jonsa, thank you so much for taking your time out and joining us on this very special edition of All About Your Company. With that, it's a wrap on this edition of the show. Thanks so much for tuning in.